It's a nice morning. We meet again for a session of financial reporting. So today we are going to do a question of group accounting. That is November 2017, whereby you would find that a subsidiary was acquired and as an associate was acquired. Even if they never told you direct, they gave you shares, whereby they said that Mwanzo acquired Safari and acquired Upia. So those are the investee companies, of which they give you the shares. So you will use those shares to determine that Safari was a subsidiary and Upia was an associate. So because already I have interpreted the question, I know that it was a subsidiary and it was an associate. But now on your scenarios, you have to use those shares so that you conclude that it was a subsidiary and it was an associate.
So I can display the question on the other side, so I can project it so that we can be able to go through before we start the presentation of the relevant statements which the examiner requires to do. So this was the question. It's a November 2017 question. They said Mwanzo Limited, Upia, and so Mwanzo Limited, Safari, and Upia operate in the clothing industry. The following information relates to the financial operations of the three companies as at 30th September 2017. So which we have non-current assets, we have current assets, we have liabilities down there. We have the liabilities. So additional information, they said Mwanzo acquired its investment as shown below. He acquired Safari and Upia. That is what I was saying. The number of shares was given. Cost of investment is provided. Retained earnings and date of acquisition. That is as concerning Safari and Upia. Number of shares which were acquired there. Cost of investment. So cost of investment is all about the purchase consideration. When Mwanzo was acquiring Safari and Upia, he paid 5,000 and 1,600. The retained earnings was 2.4 and 1.6. So date of acquisition was 1st October 2015, 1st October 2016. Number 2. As at the date of its acquisition, the fair value of Safari's net assets were equal to their book value, with the exception of Rand, that had a fair value of 400,000 in excess of its book value. So when this S Safari, I call it S, it's Safari Limited. When Safari Limited was acquired, its net assets were equal with their book value. So the net assets were equal with their book value. So the fair value of those assets were equal with their book value. That is what they have said, with the exemption of Rand. So whereby the Rand's fair value was in excess of the book value. So when there's this aspect of examiner saying that there was an asset in which the fair value was in excess of the book value, that one concerns revaluation, of which we know that the revaluation is the difference. Revaluation is the difference between the fair value and the book value. It's the difference between the fair value and the book value. So right now in this scenario, they have already provided that difference. So in other questions, they will give you the fair value to be specific, and again they will give you the book value. So obviously the book value would be below the fair value by a certain amount. Like now in this scenario, they could have said that the fair value was 1,000. They could have said that the fair value was 1,000, and for example, the book value was 600. So it means that you could have taken the difference of the two so that you get the same 400. So saying that the fair value was in excess of the book value, that is a direct revaluation. So another way they could have changed this additional information is whereby they could have said that the book value was below the fair value by 400. So when they say that the book value was below the fair value by 400. Again, it's the same thing. It's the same as saying the fair value was in excess of the book value. So that is how they can challenge you concerning the valuation. Number 3, on 1st September 2017, Mwanzo Limited processed an invoice of 100,000 in respect of an agreed allocation of management fees to Safari. As at 30 September 2017, so there was an invoice which Mwanzo processed. Mwanzo processed an invoice for 100,000 in respect of an agreed allocation of management fees to Safari. So you know that when you process an invoice, you are claiming a payment. So Mwanzo processed that, but he was paying who? Safari. So as at 30 September 2017, remember that is the period when the financial year is ending, Safari had not accounted for this transaction. So we need to account that. We need to account. So they need you just to account. Then they say that prior to this, the current account between two companies had been agreed at Safari Limited owing 140,000 to Mwanzo Limited, included in the trade receivables and the trade payables. So there is this 140. So prior to this, the current accounts between the two companies had been agreed at Safari owing 140 to Mwanzo. So this is what? An intergroup owing, an outstanding amount. In Swahili, we can say that hizi kampuni mbili kuna pesa wanadaiana ambayo haijalipwa mwaka ikienda kuisha. So that is what they say, prior to this, the current accounts between the two companies had been agreed at Safari owing 140 to Mwanzo, included in the trade receivables and trade payables. So when there's an intergroup owing, what you always do, you have to forgo the amount. This amount will not be carried forward to the next financial year, but it must be cancelled in that current year when they were owing each other. So when you cancel out an outstanding amount, let's say now the amount which is supposed to be paid by one entity to the other, and it has not been paid, it was an outstanding amount. When you cancel out that amount, you have to adjust two accounts, the trade receivables and the trade payables. That is why when they mentioned this amount was included in the trade receivables and trade payables. So we have to remove it from that two accounts. So when you reduce your debtors, it means that now you are canceling out. You reduce by crediting with 140. Then again, you reduce your trade payables by debiting with 140. So which means that this 140 will be subtracted both in those two accounts, under the trade receivables and under the trade payables. So that is how you forgo an outstanding balance. You adjust your trade receivables and the trade payables, of which under the trade receivables, you credit. Under the trade payables, you debit. So that is subtracting in both areas. Number 4, during the year ended 30 September 2017, Upia Limited sold goods to Mwanzo at a selling price of 280,000, which gave Upia a profit of 40% on cost. Mwanzo had a half of these goods in the inventory as of 30 September 2017. So they mean that during the year, there was some goods which Upia sold to Mwanzo at a selling price of 280,000, which gave Upia Limited a profit of 40%. So when there's a sale of goods, remember that you have to check for the unrealized profit on stock. Like now, Upia sold to Mwanzo at a selling price of 280. So which gave Upia a profit of 40%. But now on the side of Mwanzo, did he resell all of these goods he received by the end of the year? So they say that Mwanzo Limited had a half of these goods in the inventory as of 30 September 2017, which means that Mwanzo never resold the entire goods he received from Upia. So which means that on that scenario, you have to compute the unrealized profit on stock. But even before you go forward to compute that and adjust, these sales must have occurred between the parent and the subsidiary. So we have to determine, is this UPIA, which is an investee company, you remember that? Is this UPIA a subsidiary? So if UPIA is an associate or a joint venture, this note 4 will be irrelevant. This note 4 will be irrelevant because we don't eliminate, we don't adjust transactions with associates or joint ventures because they are non-group members. So the parent will be entitled to some items in that associate or joint ventures, like now the profit, dividends, current investment. So that is what the parent can be entitled in this associates or joint ventures. But we don't have to eliminate the transactions with those associates or joint ventures because they are non-group members. They are non-group members. Number 5, the fair value of non-controlling interest in Safari was 1.5. The fair value of the non-controlling interest in Safari was 1.5. So this one implies that when you are supposed to do goodwill, you use full method. Remember that goodwill, you can either use goodwill, like now here, when you are doing Safari Limited, Safari, when doing its goodwill, you have to use full method because I say, when computing goodwill, you either use full method or you can use partial method. For you to use full method, you must be provided with the fair value of non-controlling interest. Fair value of non-controlling interest. So which means that the NCI must be stated at its fair value for you to use full method. Like now an example of this kind. And for you to use partial now, for partial method, the NCI will not be stated with its fair value. So in short, when you see a statement right now, note 5, you know automatically when I would be doing my goodwill for Safari, I'm supposed to use full method. But now, if this statement misses from your question, you know automatically when you will be computing the goodwill of your subsidiary, you use the partial method. Because for associates and joint ventures, if you could like to compute their goodwill, obvious that when you use partial. Because associates, joint ventures, they don't have an aspect of NCI. So the only entity which you think of the method to use is concerning the subsidiary, because the subsidiary, at least there is an acquired percentage there, which is called minority interest percentage or the non-controlling interest. That is fine. So since we have interpreted these additional information, we can go direct and do the required, that is the group statement of financial position as at 30 September 2017. If there is no any question. And so the first thing we have to draw is this structure. So that is what I have drawn. So Mwanso acquired so in this scenario, they say that Mwanso acquired Safari and Upia. They give you the number of shares which were acquired. So you need to use those number of shares to get the percentages. So this is what they said. Mwanso Limited acquired its investment as shown below. He acquired Safari 80,000 and Upia 20,000. So in order to use this number of shares here to get the percentage of acquisition, so you take the number of shares acquired, you divide with the number of shares which were issued for Safari to raise a certain capital. So right now you go to ordinary share capital. So remember we are looking for the shareholding in Safari. Safari is this column, the middle column, and the UPIA is the far end there. So in order for them to raise a capital of 2,000, they issued how many shares? To raise this capital of 2,000, they issued how many shares?
Is it 2 million?
No. per share was 20 shillings. So to get this total of 2,000, it means that the number of shares which were issued is 100. You take 2,000 divided by 20, you get the number of shares which were issued in order to raise the capital of 2,000. That is the case. So this is 100. Then for UPIA is this one on the far end. It's 50, because 1,000 divided by 20.
50.
So you will be taking the number of shares which were acquired here, 80 like now, 80 divided by the 100 times 100, then 20 divided by 50 times 100. You get the percentages. And that is what they tested in the last sitting. You take 80, you divide by 100 times 100%. So you get 80%. Then you take your 20 divided by 50 times 100%. So in this scenario, you are getting
40.
So this is 40%. So we arrived at 100 by taking 2,000 divided by 20, we get the number of shares. Then we arrived at 50 by taking 1,000 divided by the par value of our share. We got a number of shares which were issued by UPIA is 50. So we took the number of shares which once were acquired, we divided with the number of shares which were issued by Safari times 100, and the same with UPIA. So once you know that, you have to draw this line to check if this subsidiary, like now here, remember that Safari now is the subsidiary, then UPIA is an associate. UPIA is an associate. So our financial year ends on, our financial year ends on, so our financial year ends on, so our financial ends on 30th September 2017. So that is according to the statement which we are given. The statement of financial position was as at 30th September 2017. 30th September 2017. So that is September 2017 here. So our financial starts on 1st October 2016. So Safari was acquired. Safari was acquired. They said that on additional information number 1. Safari was acquired even in. So Safari was acquired in 2015 October. They say that once acquired, its investments are shown below. So on the far column, this one, the far end there, they give you the date of acquisition, 1st October 2015, 1st October 2016. So it means that in the current year, these two entities were present fully in the year. So they were present in the entire year. So since we have come to a conclusion that they were present in the full year, so we will be taking the items of the parent plus the subsidiary, we adjust with the relevant items. We adjust with the relevant items. So now we can start with the consolidation. So mwanzo will consolidate. So mwanzo limited. So we have a consolidated statement of financial position. So I write in short, FB, statement of financial position. As at 30th September 2017. As of 30th September 2017. That is good. So we start from PPE. We start from PPE. So property, plant, and equipment. So starting from property, plant, and equipment, you take the parent plus the subsidiary. Parent plus subsidiaries, then you adjust the relevant items. So the parent plus subsidiary, 7960, 4600. This Mwanzo is the parent, Safari is the subsidiary. So we always consolidate parent and subsidiary. So for UPIA, we don't have to add with the transactions. UPA is an associate, of which the parent will consolidate that associate using equity method. So when we are consolidating associates, the parent will consolidate for them using equity method. So mostly now we'll be adding parent plus subsidiary, then we adjust any required transaction which is supposed to be adjusted concerning the parent plus that safari. So which means that the figure of the parent and the figure of the subsidiary there is concerning 7960 and 4600. So 7960 plus 4600. Then always here we add revaluation, because revaluation increases the value of the asset. So there was a revaluation of rand, that one I already interpreted, it was 400. Revaluation of rand. So the revaluation of rand was 400. This one they give you in additional information too, of which they said the fair value was in excess of the book value by this 400. That was revaluation. So in some scenarios, you would find that there is depreciation under change. You subtract, because now things like revaluation, you are supposed to debit. That is what I've done. You debit your PP account. So debiting is like adding. Then now this revaluation is supposed to be taken to the revaluation reserve account, whereby again you credit. For depreciation under charge, this one obvious would affect your retained profit, because you undercharged your expense, which means that the profit is more. So if the profit is more, you have to credit under this PPA, because obviously it's concerning an asset, whereby they undercharge depreciation on the relevant asset. So under depreciation under change, obviously you have to credit your PPA, then you debit your retained earnings. That is for the double entry principles. But if you don't want to understand those more interpretations, so for your case, note that we add revaluation. So due to revaluation, there is a depreciation undercharge. Subtract. And this depreciation undercharge is just taking the revaluation, you multiply with the depreciation rate, which you would be provided with. Or if you are given the useful life of the asset, you take that revaluation, you divide. So this one, we don't have a depreciation undercharge, because the asset which was revalued is rand. We cannot depreciate rand. Then after that, you have to raise UPFA. UPFA. So UPFA is when one entity sells a fixed asset to the other one. Like A selling a fixed asset to B. B never resold the fixed asset. So we know that the other entity which obviously received this fixed asset will never resell it. Fixed asset is not meant for resale. So for example, if A sold a fixed asset to B, remember A realized the profit. But now B will never resell that fixed asset. So that is why we say that there is unrealized profit, which B will never realize. So which means that we have to adjust again our retained profit and this PPE. So you compute that unrealized profit by taking the value at which the asset was transferred. You multiply with the depreciation rate. Then after that, you have to think of depreciation overcharge. Due to this set of fixed assets, there is again depreciation overcharge, because you will be told that the group charge depreciation on the asset by 20%. So the group, it means that it's both the parent and the subsidiaries. Both of them, they charge depreciation on the asset, which was sold by one entity to the other. So when A was selling, he charged depreciation on the asset. Then when B received, again, he charged depreciation on that asset. So which means that they did a depreciation overcharge. So doing a depreciation overcharge, it means that they understated the value of the asset. They understated the value of the asset. So that is why we need to add back depreciation overcharge. We need to add a depreciation overcharge. So we have to add the depreciation overcharge. And that one will be UPFA, you multiply the depreciation rate. So if you are provided with the useful life of the asset, you take the UPFA, the unrealized profit on fixed asset, you divide with those remaining useful life. And those are the adjustments you need to adjust under the PPE. So after you are done with the PPE, that is property, plant and equipment, you move to the next item, that is the next asset. So the next asset was concerning patents. That one was direct, 500 plus 840. So the parent plus subsidiary. So 500 plus 840. So the patents. So the 500 plus 840. So there was no adjustment concerning that. Then the third item is concerning now the investments. Yes, so there's this investment in Safari, Upia, and others. So the investment in Safari, remember that when you invest in associates and in subsidiaries, so let me start with subsidiary. Right now, Safari is a subsidiary. So when we invest in subsidiaries, which is Safari, we have to check goodwill. Then when we invest in Upia, so we have to account for those associates using equity method to get the net investment. So which means that under investment in Safari, I will write goodwill. I have to do a working on goodwill. Under investment in Upia, I have to use my equity method to get net investment in Upia. Then for the other investment that is direct, we will record it. So which means that I will write here goodwill, of which that goodwill requires a working. Then again, we have investment in Upia. Investment in Upia. So investment in Upia, I said this one use the equity method under IAS 28. So that one require a working. Then there's a third one there. You can see I said other investment. That one I said it's direct. Other investment. This one is direct. 300 plus 400. As we move to the current assets. So what about the current assets? So for the current assets, we have inventories, 1140 and 800. So the only thing you are supposed to raise here is UPS, and you add the goods in transit. You add the goods in transit. So for the UPS, remember that this one arises when one entity received goods from the other entity, but it never resold. So the entity which received these goods never resold the goods. Like now in this scenario, it is Upia who sold goods to Mwanzo. But remember, these sales must be an intergroup sale, not sales with associates and joint ventures. So if it's an associate and joint ventures, so that one we ignore because they are non-group members. So which means that this note 4 it's irrelevant, and that one implies that there is no UPS. So for example, if it could have been Safari who sold, like now if they could have said that during the year ended 30 September 2017, for example, they could have said Safari sold goods to Mwanzo at a selling price of 280, which gave Safari a profit of 40%. I'm using an example of Safari selling. So that one we could have computed UPS, because you find that when Mwanzo received these goods, by the end of the year, he never resold again the entire goods, because we are told half of these goods were in the inventory. So now, because it is associates who sold, we don't consider transaction with associates. They are non-group members. They are non-group members. Then again, for the goods in transit, I've said you add. Maybe it could have concerning the goods which were. It could have been concerning the goods which were done what? Sold by one entity to the other. and these goods were on credit, but they were never received by the relevant recipient. For example, if they could have said Mwanzo sold goods to Safari, that is an example I'm giving. Mwanzo sold goods to Safari. These goods were on credit, but as at 30 September 2017, Safari has not received the goods. So they were received some 2 days after the end of the financial year. So by the end of the financial year, they were on transit, which is okay. They have to be received by the relevant recipient entity. So once they are received, we have to add back to the inventories. We have to increase our inventory account. These are some of the after balance sheet events. There are items which you have to adjust to your balance sheet, even if after the financial year, but before the presentation of the relevant statement to the shareholders during the AGM. Then after that, we have trade receivables, 840 and 760. So we have to minus 100 and we have to minus 140. So why am I minusing 100? 100 was concerning an invoice which was processed and it has not been recorded. So since it was processed, they have to pay. So we reduce our receivables, and at the same time we will reduce our profit. So that is how we record it. It was an invoice which was processed and which was not recorded. Then the 140 was concerning an amount which was outstanding between two entities, and it has not been paid by the end of the year. So this one, 140, we have to forego. We have to cancel out by crediting receivables. Then when I go to payables, I have to record that receivable. That not receivable, I have to record that relevant amount which was outstanding, the 140. That is okay. And if there was cash in transit, you know that we have to subtract here. Cash in transit. So if there was one amount which was paid by one entity to the other, and it was never received by the other entity by the end of the year, that amount was in transit. So we subtract there, we add to cash account or bank. Then we have bank. Bank is just 300. So I said if there was cash in transit, we could have added there. So we have total assets. We have to talk about equity and liabilities. So for equities and liabilities, we start from ordinary share capital, share premium, if they're present, even the valuation reserves. So we have ordinary share capital here. We have share premium, we have revenue reserve. 4,000, 2,000. So ordinary share capital, that is 4,000. Share premium, 2,000. Then there was a revenue reserve. So for the revenue reserve, this one is like a retained earnings. We have a working. Then I have to introduce non-controlling interest. This one is not in the equation, but we have to introduce to check the capital of this non-controlling interest. This one we need to do a working again. So you introduce the NCI, it's not there. You introduce to determine the capital of those minority interests. Then we have non-current liabilities. So for the non-current liabilities, So we have only the deferred tax. We have only the deferred tax of 400. We have only the deferred tax of 400. Then what about current liabilities? What about the current liabilities? So for the current liabilities, we have trade payables, current tax and bank overdraft. So trade payables is 1,500 and 900. So we have the 1,500 plus 900. So the only amount I will subtract here is the 140. Then if there was goods in transit, I have to add goods in transit. So remember that this one, we have to cancel it out. It was an intergroup owings. It was an outstanding balance, which was never paid by the end of the year, and it was included in the two accounts. Even if they never said that it was included in the two accounts, once there's an outstanding amount between two entities, between parent and subsidiary, and it has not been paid by the end of the year, you have to forgo that amount by subtracting under receivables, which is crediting, and subtracting under payables, that is debiting. Then for the goods in transit, let's say if the goods were sold by one entity to the other, and these goods were on credit, and they were never received by the other entity. So since they were on credit, remember we have to increase our trade payables, the group trade payables. Then now, since they were never received by the other entity, once they will be received, or when they will be received, we need to adjust our inventory. We have to add to the inventory, the balance. And that is good. So we are remaining with two items so that we finish. So we have current tax and bank overdraft. So current tax and bank overdraft is even direct. 280 and 160. So we have total equity and liabilities. Total equity and liabilities. So give me some items here. Give me some figures. That is for the totals.
Marim, I have a question.
Yes.
On inventories, that is not number 3. Why did we subtract 100,000?
I subtracted under inventory, or I subtracted under trade receivables.
Under trade receivables.
Remember that that 100 they said it was concerning what? An invoice which was done what?
Processed.
And it has not been there.
It's not been recorded.
Yes, we have to record. So when
by subtracting, are we recording? By subtracting, are we recording?
Yes, it was an amount which was supposed to be paid from one entity to the other, from Mwanzo to Safari. So there's that group trade receivables account. So when this amount is paid, see, for one entity, the amount must reduce. When you pay an amount which you were supposed to pay and you have not recorded, which account do you record? Let's say you owe me 1,000. You process that invoice concerning the amount you allocated to me. So once you pay, which account do you record? Which account do you reduce?
Trade receivable.
Yes, I was your data. Eh?
Yeah.
That is okay. That is why.
Okay, I understand.
So the first one is 12,960. The second one is 1340. That is patents, 1340. PPE, property, plant and equipment is 12,960. Then goodwill and investment in UPIA, we have to do our working on that. Eh? This and this needs a working. Other investment is 700. Then 1140 plus 800. That is 1940. Then we have 840 plus 760 minus 100 minus 140. So this is 1360. That is 840 minus plus 760 minus 100 minus 140. Then this one is 300. That one doesn't require even computations. Then trade payables down there, that is the only one which is remaining. 1500 plus 900. And that is minus 140. So this is 2260. That is 2260. So let us do the relevant workings, then we can say that the question is complete. So the workings I have to do is goodwill, investment in UPIA, revenue reserve, and an non-controlling interest. The four of them. Eh? So let us compute goodwill. And remember that the goodwill we are doing is that one of Safari. The goodwill we are going to do is that one of Safari, of which I said we use full method because already we have the fair value. We have the fair value of the NCI. So which goodwill is equals purchase consideration minus share of net assets. Share of net assets. So we start from purchase consideration. So when Safari was acquired, they paid 5,000. So fair value of NCI. So the fair value of NCI, it was 1,500. Then we raise net assets. It's obvious, I know you have your mind. Where is this figure coming from? These figures are here. The purchase consideration is this one, in note 1. And it's the one which is again given in the statement of financial position as investment. So they said once acquired its investment are shown below. So when you acquired Safari, you can see they paid 5,000. The cost of investment, 5,000. It's the same investment which is under the statement of financial position, under investments. It's supposed to be the same. So if you cannot be given down there, come here to the non-current asset, check the investment in that relevant subsidiary. You can see it's the same, the 5,000. Then I said, for you to use this full method, you must be given this statement 5. They said the fair value of non-controlling interest in Safari was 1.5. So that is why I'm using 2 columns. The first goodwill which we get, this one goes to the parent, this one goes to the NCI. This one goes to the parent and the other one goes to the NCI. That is fine. So we start from the ordinary share capital. Remember, these are some of the net assets. Those are some of the net assets. Ordinary share capital, share premium, retained earnings, revaluation reserve. So those are some of the retained earnings. So those are some of the net assets you can have. So the net asset you have to use is that of Safari. Remember, for now, Mwanso is computing the goodwill of Safari. So we have started with the purchase consideration, which Mwanso paid when acquiring Safari. We have checked the fair value of NCI of Safari. So again, we have to go with the net assets of Safari. So right now, ordinary share capital is 2,000, share premium is 1,000. So this, so that is, remember that Safari was acquired up to 80%. So 80% of, and 20% of that 2,000. So 80% of 2,000 goes to the parent, and the 20% of 2,000 goes to the column of NCI, that way. Then share premium, you do the same. It was 1,000, so 80%, 20% of 1,000. So get 800, and this one is 200. Then the next one was revenue reserve, of which you need to know that for revenue reserve, it must be as acquisition date. It must be as acquisition date. So the figure used for the relevant revenue reserve. So it must be as at the date when the relevant subsidiary, right now Safari was acquired. When Safari was acquired, its revenue reserve was, so that is what you need to use. For ordinary share capital and the share premium, you pick the items you have direct from your statement of financial position. But for revenue reserve and revaluation reserve, you have to go with the items or the figures as at the time that subsidiary was acquired. They gave you the figures. They provided the figures here, note 1. Remember, revenue reserve is the same as retained earnings. That is what you need to know. So as at the time when Safari was acquired, 1st October 2015, the retained earnings was 2,400. The retained earnings was 2,400. 2,400. So if I take 0.8 times 2,400, I get here 1920. Then if I take 0.2 times this, you get here 480. Then the last thing is concerning revaluation. So and this one, remember I've said again, it must have been as acquisition date. So remember that there was revaluation of RAND, or which they said it occurred as at the date of acquisition of that relevant subsidiary, which is Safari. So it was as at acquisition date. Note 2, they said that as at the date of acquisition, the fair value of Safari's net assets were equal to the book value, with the exception of RAND, that had a fair value of 400 in excess of the book value. So 80%, 20% of the 400. You can see it was as at acquisition date. So this one is 320 because 80% of 400. That one is 320. So this is 80. So you subtract from now the relevant purchase consideration and fair value of NCI. So I take 5,000 minus 1,600 minus 800 minus 1920 minus 320. So I'm getting here 360. So just a minute, then I will answer your question. Just a minute. So 1500 minus 400 minus 200 minus 480 minus 80. So this is 340. So which means that here we have the goodwill. So that total goodwill is 700. Eh? So that we impair. We say rest impairment. So I've written dash there because there was no impairment. They could have told you that the goodwill arising from Safari was impaired by a certain percentage. They never talked about anything like that. Eh? They never talked about impairment. They could have said that is the scenario when we could have computed. So the let us do now the investment in associate. So for the investment in associate, you have to use the equity method. You have to go with the equity method. So this is according to IS 28, International Accounting Standards 28. So first you recognize the associate with initial cost of investment. Initial cost of investment. So initial cost of investment, then you add the share or post acquisition, the share or post acquisition profit, stroke reserve. So in this question, there was revenue reserve. So this one is the only one which was there. And then we have to raise impairment loss. But even there was no impairment. There was no impairment. So up to that point, you can get net investment. And that is fine. So we determine the initial cost of investment. So the initial cost of investment is, so this initial cost of investment, remember we are doing UPIA. UPIA is the associate. So the cost of investment here is 1,600, according to note 1, 1,600. It's the same which is given under the investment here. These investments, UPIA, 1,600. Then now we have to add post-acquisition reserves. So I said it's only the reserves which is there, which is the profit, because the revenue reserve is the profit. There is no revaluation reserve. I'm saying there's no revaluation reserve because if you go to your statement of financial position, so to record those relevant profit or revenue reserve, that is, I've said, in order to record that profit or reserve, it must be provided here under equity. So the only thing which we were given under this equity is the revenue reserve. Revenue reserve, which I said is the same as the profit. So there's no revaluation reserve here. If it could have been here, it's when I could have considered revaluation reserve. Not the one which is under additional information. So for you to consider it under equity method, it must be provided in this statement under the equity and reserves. So let us determine the post-acquisition. for revenue reserve. So the share. So now to determine the share, what you always do, you take this balance carried down, you minus the balance which was there as acquisition date. You take the balance carried down, 2,400, you minus the balance which was present as at the time when Upia was acquired, 1,600. You multiply with the rate. Like now it was 40%, 2,400 was the balance carried down. Because statement of financial position balances as are at the end of the year. You minus the one which was there as at the time when the relevant investee company was acquired. That is how you get the post-acquisition reserve. So carry down minus the balance which was present as acquisition date. The balance carried down is the one which is in the balance sheet. Then the one which was as acquisition date is given in additional information number 1. You multiply with your 40%. You get your 320. So getting 320, you add it to 1,600. You get 1,920. So that is all. NCI account before I do the revaluation reserve. Remember, we are remaining with only one working. So ordinary share capital, we have share premium, we have revenue reserve, and we have revaluation reserve. So those are the items you start with when you are doing your NCI account to check for capital. This one is for capital purpose. So the ordinary share capital, share premium, revaluation reserve, revaluation reserve. So are this, you pick just the same items you picked under goodwill. It's only that you will apply now the 40%. You will apply the 20%, not 40. Remember that NCI is the percentage unacquired in Safari. The percentage unacquired in Safari, which means that these are the net assets. So you take 20% times 2,000, 20% of 1,000. So 20% of, and the 20%. So for revaluation reserve, it's 400, which is fine. But now for the revenue reserve, you don't have to use the one which was at the acquisition date. Remember that you pick the one which are direct in the balance sheet. It's the same I have done for the ordinary share capital and the share premium. So in short, I was supposed to copy this. So I have taken 2,000, 1,000. So the revenue reserve is this 3,800. Then the revaluation is the one which was under additional information number 2, the 400. The 400. So the revenue reserve is this 3,800. This is what we have picked from here. So 3,800. So I can be able to get this is 400. This is 200. So 0.2 times 38. So this is 760. Then 0.2 times 400. This is 80. Then after that, we have to determine depreciation overcharge. The depreciation overcharge. So the depreciation overcharge, this one maybe was concerning if an asset was sold, but there was no asset which was sold between the two entities. So the intergroup sales of a fixed asset was not there. Then again, we have to record the goodwill. But the goodwill of an NCI. The goodwill of an NCI, which is 340. This one. the 340. So that on this side, if we have depreciation overcharge here, here we have depreciation undercharge. It was not there because even if we had revaluation, the revaluation occurred on a land and you cannot depreciate land. So UPS, if sell subsidy, this one was not there because Safari never sold any goods. It was Upia who sold. And Upia was an associate. Then impairment loss. But this one will be used if full method was used. Even we never had any impairment. Then now the last thing I have to record is concerning management expense. 300, which was being processed by Mwanzo, the invoice, which was processed by Mwanzo, and it was being allocated to Safari. So even if it was allocated to Safari, remember Mwanzo never controlled Safari 100%. So there was 20% of that claim, which was supposed to be attributable to this NCI. So you take 20% of the 100, you get a 20. So you take 400 plus 200 plus 760 plus 80 plus 340. So yeah, the total is 1780. So 1780 and 1780. So the 1780 minus this is 1760. So that is my balancing figure here. My balancing figure, and that is what is attributable to the NCI. So that is what we have been looking for. So I can record the relevant items before even we continue. So goodwill, we have 700. Investment in Upia, we have 1920, this one. And for the NCI, we have 1760. So let us do this. That is revenue reserve. So for the revenue reserve, again, it was just direct. Because I would just make it to be more direct, Mwanzo, I have Safari here, and I have Upia. So I will start with my balances. Balances as per trial balance. So the balances as per the trial balance. So the balances as per the trial balance. For the three entities, so we take 9,000, 3.8, and 24. So these ones, revenue reserve, 9,000, 38, and 24. 9,000, 38, and 24. So remember that this is all about the retained earnings, which is the revenue reserve by the end of the year. We need to get the retained earnings for the current year, of which you know that Safari was acquired in 2015 and Upia was acquired in 2016. That is according to additional information number 1. So you are told here, date of acquisition, 1st October 2015 and 2016. As at this time of acquisition, you can see you are given retained earnings, 2.4 and 1.6. But what we have recorded is the balances by the end of this year. So which means that as at the time of acquisition of these two entities, they were having these retained earnings. So when we will be closing the current year, remember that this amount of 2.4 and 1.6 were included under this profit we have, because those balances obviously were carried forward from those years, so that by the end of this current year, these two amounts, retained earnings and so the retained earnings, the two amounts I mean, the 2.4 and 1.6, they were obviously included under the balances we have by the end of the current year. So to get the retained earnings or revenue reserve, the correct balance for this year, we have to deduct these retained earnings, which was present as at the time they were acquired. So you take 2.4, you subtract, and 1.6, so that to get the correct retained earnings in the current year. Then the last thing I have to raise, so this one which I've subtracted is concerning the retained earnings as acquisition, which we call it pre-acquisition. So the pre-acquisition retained earnings. So another thing I have to raise is concerning that management fees, which was going to this. The management fees, that are 100. So up to that point, we can be able to get we can be able to get 13 here. Then you take 24 minus 16. So this is 800. So the parent will be taking 80% from this one, and it will be taking 40% from this one. So you say your Safari. So you take 80% of 1300, and for Upia, we have 40% of 800. So this is 320. Then the first one is 0.8 times 1300. So this is 1040. So let me add. Now you will be able to add to get the total profit which the parent will have consolidated from those two entities. That is from Safari and Upia. So take 9,000 plus 1040 plus 320. So get 10,360. 10,360. So the 10,360 is what I will record as my retained earnings. They call it revenue reserve. So let's check if our question is balancing. If our question is balancing. So PP, the balance on the end, on this side. So the balance for this one was 12,960. 12,960. And the patent is 1340. So you start there. So 12,960 plus 1340. Then you add with the other assets on this side. So PP is 12,960 plus 1340 plus 700 plus 1920 plus 700 plus 1940 plus 1360 plus 300. So this one, I'm getting 21 220. Then what about equities and liabilities? So 4,000 plus 2,000 plus 10,360 plus 1,760 plus 400 plus 2,260 plus 280 plus 160. So it's the same. 21 to 20. And that is how you are supposed to do this question. That is how you are supposed to do the question. Any question so far? So good. So you can see you can do this question anyway without a lot of workings. So let's say, for example, the first thing I did without
workings. Remember that the workings I did later, like now Goodwill. Another one we did is concerning investment in associate, revenue reserve, and NCI, the 4. Even without the 4, you can score enough, making you to pass the paper. Because like now for the PP and the patents, that is you can do it without working. That is 2 marks. That is without working. Investment, that is 3. We have 4, 5, 6. We have 7, 8, 9, 10, 11, 12. So without the working, without the 4 workings, you can be able to get 12. And remember, the examiner was in need of how many marks concerning this question? The examiner was in need of 14 marks. So the workings would be wasting your time looking for the 2 marks. That is how you always work out. So you can even leave the workings and continue with the other question since you have done the other perfectly without the 4 workings. Because sometimes workings waste a lot of time. And at the same time, you might not score some. Yes, you might score some of the workings, but some you might miss because they need a bit of good understanding. So which needs good training and a good revision before the exam. So you can ask your question and so that you can call it a lesson. So for my YouTube students and other guys in the Facebook and other social media platforms, I could urge you to continue subscribing to my channel, and at the same time, if you could like to prepare 100% without doubt, so you can subscribe to my Zoom classes, of which some are ongoing, but never worry. Even if we have gone a bit far, if you join now, I would be able to repeat what you have done. And at the same time, so I will be able to repeat what we have already done. So at the same time, I have the videos I would be able to share with you. So if you could like to join my sessions, you can be able to reach me through 07 28 760 546. So this is my personal contact. So you can call me if you would like to join those classes. And at the same time, never forget to subscribe to my channel. That is CPA Edwin Ochoy. So CPA Edwin Ochoy. So never forget to subscribe. Subscribe. Never just watch and move away. Subscribe and also press the notification button. There's something on your far right, something like a bell. So press on that. That is what I call a notification button, so that you will be notified. So the main purpose of doing that is that when I will be uploading another video, you will be able to notify that I have uploaded another video when you have a notification button on. You will be automatically notified once I upload another video. So you can have a nice time. We meet next time for more sessions. And I've done this question because it was a demand. Because some guys have been watching the first part of the question without the second part. So this question contains everything concerning what you have been demanding concerning this relevant question. Have a nice time.